I mean, they're not going to say we're creating a hyperinflation here. Presumably, they're feeling that they can cut back on the money supply growth. If they can bring the money supply growth under control and keep inflation under control, they may well be able to do that. But the problem I see is they don't have a way out here yet. They don't have a stable circumstance where they can pull away from the accelerating monetary growth. They will do whatever they have to do to keep the financial system from collapsing.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs. Welcome back to Liberty and Finance. We have a distinguished returning guest. John Williams is the founder and host of shadowstats.com. He has been a stalwart pioneer in the area of truth when it comes to telling what's really going on in the economy and in our financial world in the face of headline statistics that would otherwise mislead us. So in our desire to be aware and prepared, we're always grateful, John, for you joining us here again on Liberty and Finance.
Well, thank you for having me, Dunnigan.
I just wanted to mention that to everyone that today is Friday, June 11th, 2021, and we're just grateful for your presence here. There's been so much talk going on having to do with the presence and the importance of inflation, how it's impacting everyone's lives in a very real way, and how it's been underplayed extensively by the powers that be in our headline CPI, Consumer Price Index, and other numbers, and that how that affects policy positions that are taken by the Fed and by others that can impact earners, savers, retirees, Social Security, etc. So could we start there? And then I think you're going to talk to us a little bit more about what's really going on with our economy and how perhaps the so-called super V or V-shaped recovery is a lot closer to an L-shaped recovery if we look at the truth about the statistics. So could we start off with inflation? And I guess maybe on the heels of the Fed having recently made quite a significant amendment to what they had claimed was insufficient inflation, 1.6, 1.7% for the longest time, when you were talking to us in the past about actually, folks, it looks more like 6 to 10% of what people are really being impacted by. And then now, the most recent forward-looking forecast that I recall coming out from them north of 4%, but still saying it's not enough. So help us demystify the confusion around the truth about what's really going on with inflation and what it means to ordinary people.
Well, up front, I've had serious problems with the way the inflation's been reported in the last 40 years. The government in the early 80s redefined the way they measured certain elements to reduce the level of inflation. They'd had up through 1970-71, the dollar was tied to gold, and Nixon floated the dollar, and up through that point in time, you could look at domestic inflation and gold, and they pretty much moved together. After Nixon parted from the gold standard, gold continued to rise, and inflation arose, but it was getting too high as far as the politicians were concerned, because they had to pay a cost of living adjustments and such on Social Security. And rather than be honest with the American people, they reworked the CPI to reduce what was being reported and again, what they would then have out of pocket. First thing they changed in the early 80s was the housing component. In the Consumer Price Index, at that time, it included a part of the index, the cost of buying a new home. They eliminated all that and created what they called a homeowner's equivalent rent that the government estimated. And then it was what a homeowner would pay himself to rent his house from himself. And then they'd work out the monthly inflation on that based on how much the homeowner would raise the rent on himself each month. Completely arbitrary, phony number, but it had the effect of knocking roughly 1.5 percentage points off the headline inflation. And to put that in general perspective, last year, the headline inflation was 1.3%. Just that one item there would have more than have doubled the headline inflation had that not been done. And they made other changes over time, aggregate impact of about 7 percentage points. That said, coming into where we had a year ago, this is the cost of living adjustment that was being made to Social Security based on the inflation as of the third quarter of 2020. It's 1.3%. Right now, the measure that's used there, which is it's the consumer price index for all urban wage earners, and the numbers that just came out for the month of May, that was up 5.7%. And if it continues there for another couple of months, the cost of living adjustment for Social Security is going to be a lot higher than it was for this last year. So we're beginning to see a pickup here, but this is not catching up to what's not being reported. This is a pickup in underlying inflation, which the Fed has created by printing excessive money supply. And the reason they're doing that, very simply, it's a very difficult circumstance, is that we've had this terrible pandemic that as the economy was shut down by the federal government, the Fed took action to provide liquidity to the economy, to businesses, to the American people. The federal government came in with massive fiscal stimulus, but the Fed had to keep the banking system afloat. We didn't want to see an economic crash. So what they did was they just created whatever money they had to create. And when you look at the money supply, which is the measure of effectively the currency in circulation, at that time, you had two components, the M1 and M2, which was a broader overall measure, which includes M1. M1 is basically, it's the most liquid, or was, which is cash and checking accounts, basically. You get into time deposit savings accounts and such in the broader measure. What you were seeing as the crisis evolved and as a year-to-year growth in the M1 got up towards 70%. They redefined M1 because M2 was growing, 25% at the time. And what you're seeing was that people were moving out of the less liquid assets into the more liquid. There's a flight to liquidity, a flight to safety. I don't think the Fed like to see that because people were talking about why are people doing this. So they redefined M1 basically to take on the savings deposits, which were in M2, and all of a sudden M1 was 92% of M2. So all the big growth that you saw there softened out, and it was basically just growing along with M2. What I look at and what I put out is what I call basic M1, which remains the cash and checking accounts. The other checking accounts you can no longer pull out of their numbers, but that still accounts for 83% of what M1 used to be. And again, you're up around 75% year over year there. Nothing like this has ever been seen. And usually in the United States, and usually that is a precursor to inflation. The stronger the money supply growth, the higher inflation will be. Some people talk to me about the velocity of money, that you have to have high velocity of money to have inflation. What velocity of money is how quickly the money supply turns over in the economy. So you take the GDP, which is a broad measure of the economy, and divide the level of the money supply into it. The higher the velocity, the more it turns over. The concept is that's going to speed up inflation, which it does tend to do. It also speeds up the economy. That's not what gives you hyperinflation. What gives you hyperinflation or the hyperinflations we've seen generally have not been strong economies. If you have a strong booming economy, yes, you'll tend to get higher inflation with that, but it's something of a healthy inflation. If you look at the Weimar Republic of Germany, that was not a strong economy, anything but. And if you create a lot of money, throw a lot of money into an economy that's not growing, in fact contracting, which is a circumstance that we had, that tends to create inflation and can give you a hyperinflation. And right now, we're not at a hyperinflation. I think we've got a high risk of it. But we're seeing rates of inflation now that haven't been seen in quite a while. If you look at the numbers that came out for May, the headline consumer price index was up 5% year over year. Now, that's the strongest headline, just basic inflation, seen since August of 2008. So you're looking at the highest inflation in 13 years. There's some funny things in the recent inflation have been tied to what happened to oil prices last year. You had an oil price war. Oil prices collapsed. Oil prices, gasoline prices are very significant in terms of the inflation measure. So some people, particularly the Fed, like to tout core inflation, which is the CPI basically net of food and energy, which indeed can tend to be high in inflation, although people do need food and energy to live. But if you look at the core rate, as it was published for May, that was at 3.8%. That was the highest since 1992. That's 29 years. We're beginning to see numbers that people have not seen before, in recent times. And I can tell you from an anecdotal standpoint, with clients, I talk with people I know in different businesses, that those at the wholesale level, the construction trade, fabrication, on down the line, they're all seeing big surges in prices, order of magnitude, ranging from 30 to 100+%. You look at the construction trade, lumber's up at least 40%. Some of the construction items are up 80% year over year. That's not normal inflation. It's not quite hyperinflation, but it's the type of thing that suggests that we have higher inflation down the road because it gets passed along. People involved in producing the goods or the middlemen have to pay that much more for the product. They pass it along. And the feedback I'm getting is they're not having any problem passing along the higher prices. So there's more inflation coming here down the road. We just haven't seen it yet in the headline reporting. And there's an issue there, too, because if you look at the press release from the Bureau of Labor Statistics on the May numbers, they indicate that they highlight that because of the COVID crisis, they are not going out and looking at items on the store shelves for the surveying. It's all being done remotely. And that's important because I think people are beginning to recognize that a number of manufacturers have cut back a little bit in the quantity of product that they're providing, but keeping the packaging the same to try and keep the prices down. Some people call that shrinkflation. The Bureau of Labor Statistics normally would pick that up because when they go into a store and let's say they look at a box of cereal or a roll of paper towels, they will note the quantity, everything on the package, so that if there's a change in the quantity in the packaging, they'll pick that up and they'll adjust the price accordingly. They're not doing that at the moment. And there's a lot of talk of the so-called shrinkflation. So we're not getting a really good number, but it's probably understated. But the indications are here that we still have higher inflation ahead. And as long as the Fed continues to spike the money supply, and I think that's going to continue. I know they'd like to pull it back some. I think you're going to see continuing acceleration there. That will tend to fuel the inflation more.
Along the way in that discussion, you talked about that the underlying economy is not doing as well as we've been told. Could you talk to us about specific reasons, facts, evidence of that you're seeing, and people, again, how this plays out in the impact on ordinary people's lives?
Well, if you listen to the hype in the press that we're effectively at or near economic recovery, my gut reaction is that can't possibly be, because you have, if you look at payroll employment, right now, year-to-year change there, when I'm talking year-to-year change here, what I'm talking about is against the pre-pandemic peak in the case of employment, or trough in the case of the money supply, which would be February of 2020. The problem is that after, when you get into March and April, you had such a radical shift in the economy and the money supply that you can't look at it on a year-over-year basis and make much sense of it. I mean, if you look at payrolls, for example, they're up 10% year over year, but they're still down 5% below the pre-pandemic peak. So when I'm talking about the growth here, it's against that pre-pandemic peak in activity. And that is order of magnitude where we are right now. Does not have historical comparisons going back to the end of World War II. It was last time you saw anything like that was when the economy was being restructured after the war, going back to a peacetime footing. So that for normal functioning, it's really more Great Depression type numbers than anything you've seen in a modern business cycle. And my friend payroll, the people who are working, that's your basic measure of economic activity. And if you've got your payroll still at depression levels, there's no way you've got a healthy, happy economy. That's my initial observation on it. That said, nobody's seen anything quite like this before, and to measure it has been difficult. But the government has done its best there, and you've had estimates on the gross domestic product, which is the broadest measure of the economy, and you saw a collapse into the second quarter, and then it's come back. Unusually, the expectations have been right on the mark as to what's been reported. The revisions have been absolutely minimal. That's very unusual. They're doing the best they can with limited ability, but they still have the underlying reporting of such areas as industrial production and retail sales. Funny thing with industrial production, most of these areas, like industrial production, go through an annual benchmark revision where the issuing authority, in this case the Federal Reserve, gets better quality information than they had the year before, and they'll make a revision so that it's more representative of what actually happened. We did not have the last two benchmark revisions, and what happened was the first one didn't happen because of the government shutdown tied to the deficit. The second one, they just kept putting it off. We just got a benchmark revision on industrial production that knocked 5% off the level of industrial production last year. That's a significant number. You also saw a downside revision of that magnitude in new orders for durable goods. And what it shows is that the economy actually was turning down into the pandemic, that the peak here in the economy was probably back in 2018, late 2018, and was turning down into 2019. That was evident in a lot of numbers, but never reported as such. And of course, the Fed didn't revise their numbers. But the industrial production was the original GDP measure. They started publishing that back in 1919, and then later they got real fancy with them. But underlying production has always been a good indicator of what's happening with the GDP. And when you get a major downside revision to the production, one usually follows as well with the GDP. And because of the shift in pattern here, I think when these numbers come out, we'll see that the economy indeed was slowing down into the pandemic instead of just being hit by the pandemic. And as a result, we've had a steeper decline. The pandemic just collapsed everything. But we're starting from a lower level, and it's going to take us a while to get all the way back, more than currently is anticipated. You find that the collapse and the economic downturn were deeper, and the recovery so far has been shallower than has been advertised. We've got another benchmark revision, in this case to the trade deficit, last week, and there the trade deficit was revised to a wider number in the last year or two. That too is a negative for the GDP in revision. So come July 29th, which is when we'll get the annual benchmark revision to the GDP, I expect that you're going to see some shift in pattern. We'll see some downside revision to the historical GDP. As a result, you'll find that from the peak of the economy to the trough, as estimated with the pandemic collapse, that'll be a deeper decline, and that we're not as far back in coming off the bottom to actually get to a recovery. Recovery is defined basically as recovering the pre-recession high, in this case the pre-pandemic high. Industrial production, barely, if at all. In fact, I think industrial production may not have ever recovered its pre-Great Recession high. It had in the earlier reporting, but the manufacturing sector that is a dominant component of industrial production never recovered its pre-Great Recession peak, and it's now deeper. So the economy is not quite as has been advertised, but the average guy has known that all along.
Yeah, if we could zero in on a couple of things there. One is very interesting, both these continual downward revisions of numbers that were already announced previously, but also the fact that the pre-pandemic economy was in much worse shape than was being officially touted. We had, as you mentioned, manufacturing suffering. We had transportation index and shipping way down. In fact, we had an interview with a executive who interviewed with us anonymously from the trucking industry way back in like September of 19. We titled that interview Red Alert, Economic Red Alert from Inside the Trucking Industry, because he said we are a leading indicator. We see these things before they exhibit themselves in the broader economy, and we're seeing a more of a slowdown than we've seen in since the Great Recession, and even greater. There's two big elements there. One is that the economy was already struggling and already on its knees. I know Danielle DiMartino Booth, when we had her on in that time frame as well, talking about this warning coming from some statistics which had always, without fail, correlated to within 18 months prior to a major recession. She says, we're on the clock, was her quote. And this is all completely prior to the pandemic and the clampdown response. And then secondly, these revisions, this whole thing of, we'll eventually tell you the truth, probably. But right now, we're just going to tell you, here's what's happening today. Today is rosy. Today is sunshine. Everything's fine today. But oh yeah, you remember last year when we told you that? Yeah, that wasn't true. It was actually stormy and raining and terrible last year, but we told you it was sunny. But today it really is. And then when you persist with that, human psychology is we become emotionally attached to that which we hear or exposed to first. So we're just so gullible in the sense that people are psychologically predisposed to be persuaded by what's being told. This is the latest. This is the latest. This is the latest. And then later on, those big headlines, we'll revise that with a retraction on page, in the small print at the back of the newspaper.
There's a reason that you see that pattern. And it is, I've been working in this field for 40 years. Early on, I got to know some people who actually generate the government's reporting. And for example, if you look at the payroll employment, key number, but if you look at it, each year there's an annual benchmark revision where they go back and they take hard surveys and they correct the numbers, and almost always the numbers get revised lower. And talking to people involved with the process, the reason for that is that there's pressure, not official, but if you're working at a statistical agency, the current administration wants to see positive numbers. At least they don't want to see artificially negative numbers or numbers that are negative that later get revised higher, because the negative numbers will hurt them politically. So they tend to put in a little bit of an upside bias there to keep the numbers from understating what's happening, and then they'll adjust it down the road. It's seen almost across the spectrum. I don't care what the series is. Invariably, it's not 100%, but large percentage of the time you'll get a negative benchmark revision with a major series, and it's for reasons like that. Nobody wants to be wrong on saying that it's weak, because that can cost them a job.
Wow. That's part of our mission here, is being aware and prepared, helping people be aware and prepared. So it's like, how can we be prepared unless we're aware? How can we be aware if we're listening to statistics that are inherently have a conflict of interest? We have a question here that's fairly specific from a viewer, and I don't mean to put you on the spot, but I think you can probably give us some rule of thumb or some guidance on how to do this kind of calculation. The Silver Merlin says, I've been looking forward to hearing from Mr. Williams for a while now. Can you calculate what the 1980s silver spike price, which is approximately $50, would be in today's dollars adjusted for inflation as per Shadow Stats metrics, which is, I guess, distilling that down, it's what is a dollar worth now compared to what it was worth in 1980?
let me put it this way. The annual inflation, I'm estimating, is about 7 percentage points higher than is being officially reported, so it's quite significant. I mean, I can calculate it for you, but I don't have the numbers right in hand to do that. If you go to my website, there is a page that gives you the detail on my alternate inflation measure. Anyone wants to send me an email at johnwilliams@shadowstats.com. I'll be happy to work a figure for them. I can tell you it's a significant difference. One thing you have to keep in mind with both silver and gold, and it's not. That's why I'm not. I'd be a little hesitant to use a number that comes out here, because they are both indicators of inflation and actual inflation. One thing I had not done here until recently was actually plot my inflation measure against gold. I should have done it some time ago, but what happened here, when Nixon abandoned gold back in 1970, and I think it was 1970 that I set as sort of 100 for my index, so it wasn't that far off from gold. But if you look at my index, which continues the inflation the way that it had been reported, at least estimated, so that again, right now, where the latest numbers are showing headline CPI inflation year over year of maybe 5%, my numbers should be showing about 12%. If you plot my index against gold, and I've done this back to the founding of the Republic, gold basically leads my index, and it's very close. So that the price of gold, and I probably should do this with silver as well, but the price of gold here really is a measure of inflation. The purchasing power over time is fairly consistent. It catches up. It's not always exact, but it does. If you look at what I'm showing in inflation against what's happened to the price of gold in the period of time that we've been off the gold standard, it's remarkably close. Deflating it by actual inflation probably is going to show you that gold keeps up with actual inflation. It doesn't keep up, it exceeds. The reason you see the soaring gold price is that it's keeping up with actual inflation, but people just see the headline inflation, so it looks like it's soaring. It's soaring, indeed it's soaring in value in terms of the way it's measured by the government. If you're holding the gold, it's preserving your wealth. Again, a same amount of gold that would buy a loaf of bread back in ancient Rome would buy a loaf of bread today. I was addressing a monetary group once in New York, and a fellow said, well, my mother loved to go to the Broadway plays when she was a little girl, and they'd always get third row center, which is prime seat. It only cost them $5. And I was complaining about that, and I said, well, she had the same $5 gold piece that had got her that seat. She could still get a seat third row center for a Broadway play. Gold maintains its purchasing power over time, so that it's really where you're inflation adjusting it using my numbers. You'll find that basically gold hasn't gone up much in value. It's stayed fairly constant over time, but that's what you want. You want a store of wealth. That's what it is. So silver is similar, but it's more volatile. In terms of the request, I'm happy to provide the numbers, but deflating a monetary metal, it's interesting. It should show that the metal is pretty much covering the inflation.
All right. What's your thought? We have a question here from Sarge 27271. He says, what is your point of view on the, quote, transitory inflation story coming from the Fed?
That's what they have to say. I mean, they're not going to say we're creating a hyperinflation here. Presumably, they're feeling that they can cut back on the money supply growth. If they can bring the money supply growth under control and keep inflation under control, they may well be able to do that. But the problem I see is they don't have a way out here yet. They don't have a stable circumstance where they can pull away from the accelerating monetary growth. They will do whatever they have to do to keep the financial system from collapsing. At the moment, that's fueling it with liquidity, which you're seeing. Extreme. The pace of growth against the pre-pandemic trough has slowed down a little bit. The monetary base looks like right now it's up about 75% from its trough. Now, the monetary base is there. That's cash in circulation and reserves at the Federal Reserve banks. The monetary base has, in terms of year-over-year change, exploded back in 2008 when the banking system was collapsing in the Great Recession. That's why you had it. But you haven't seen anything in terms of the monetary base like that since. They never brought the monetary base down significantly from that crisis level. What we're seeing now is really unprecedented. Next couple of months, watch what happens to the narrower liquidity measures, the cash plus the checking deposits, which I refer to as basic M1. That continues to soar. They don't have a way out.
Interesting. Well, John, we've got so many questions. I guess if we could just hit one quick one. There's about 3 or 4 questions that have been asked. I'll distill them into a single, and that is, what are your thoughts on the upcoming enactment of Basel III regulations, which are going to require the international banks to hold 85% or to count at 85% some of their collateral against other positions? And some people are saying it's going to cause an end to the unfettered manipulation of metals prices that might be masking some of the true indicators that you're talking about, how gold and silver normally would indicate the true rate of inflation or precede it. Do you think from your studies that this will in fact be enacted? And do you think that it'll have a significant effect that ordinary people will be affected by?
Let me put it this way. That's not going to happen until the situation that we've just discussed is resolved. And I don't know that it is going to be resolved. I think we're going to end up with a hyperinflation, in which you're going to end up with some kind of a currency reset and a systemic reset, probably going back to something like a gold standard. So, I mean, it's nice to talk about, but I think everything is going to be subject to rearrangement, rethinking here in the next couple of months, because the system's not stable. And I think they're going to have a lot of trouble keeping it stable. It's not just the United States that's having a problem. Anything that can stabilize things should be a plus, but I just don't see it happening yet.
Well, John, we're out of time for this segment. We thank you so much for joining us again here on Liberty and Finance. And if people want to follow your work, where can they get plugged in?
Well, shadowstats.com. That's my website. And you go there on my homepage, right-hand column, and it's open to anyone. I update whatever's happening in the economy. That as the numbers come out, I usually publish something there within a couple of hours. And my general outlook is described there, and I put out a commentary, try to make it at least monthly, and it varies by what's going on, but that's by subscription. You can see samples. You can see the recent history. After 3 months, it's available to anyone. So always happy to take on new subscribers, and subscription details, again, are there on the website. Background on the alternate data, such as my inflation numbers there, also my alternate estimate on unemployment. They changed the unemployment way they measured unemployment around NAFTA so that long-term discouraged workers would disappear from the numbers. Shadowstats.com.
Very good. Thank you so much, John Williams, founder of shadowstats.com. And as we strive to fulfill our mission of helping people be aware and prepared, we want to have you here in our corner. You're a great ally with that. And just thank you for being with us here again on Liberty and Finance.
Well, and again, thank you for having me.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.